Hey everyone, ready for another deep dive? Today we're tackling financial statements with The Layman's Guide to Understanding Financial Statements.
Great book.
Yeah, and you know what hooked me right away?
What's that?
The author's story in the intro about his bookkeeper. Ripped him off in his first business.
Oof. Yeah, I remember that. Definitely grabs your attention.
Totally. Makes you realize how important it is to understand this stuff.
Absolutely, no matter what role you play in business.
Right. So let's break it down, starting with something the book explains well. Bookkeeping versus accounting. What's the difference?
Well, you can think of bookkeeping as like keeping a super detailed diary of all your money stuff, every single transaction.
Okay, so like tracking the nitty-gritty. What about accounting then?
That's where you analyze that diary, find the story behind the numbers, the bigger picture.
So like the bookkeeper is collecting the data and the accountant is the detective.
Precisely.
Gotcha. And just to note, this book focuses on U.S. accounting principles, those GAAP things. Right, important if you're dealing with U.S.-based companies.
For sure. Now, let's get to the big guns, the financial statements themselves. We've got the balance sheet, income statement, and the cash flow statement.
The big three. Each tells its own part of the story.
Okay, let's start with the balance sheet. To me, it's like a snapshot, right? Showing what a business owns, what it owes, and what's left for the owner at a specific point in time.
You got it. And there's a fundamental equation to remember. Assets equal liabilities plus owner's equity.
So assets are what they own, liabilities what they owe, and equity is the owner's stake. Makes sense. What about the income statement? That's more like a financial movie, right? Seeing the performance over a period of time.
Exactly. It shows you the revenue, expenses, and whether the business made a profit or loss during a specific period.
Revenue is money coming in, expenses going out, and the differences are profit or loss. Makes sense. So what about the cash flow statement? What makes that one special?
That's where you see the actual flow of cash. Where's it coming from? Where's it going? It's all about the movement. Crucial for short-term survival.
So even if a company shows a profit on the income statement, they could still be in trouble if their cash flow is messed up.
Exactly. It's about having the cash on hand to pay the bills, not just looking profitable on paper.
Wow, starting to see how these statements all fit together. Oh, and the book mentions the statement of owner's equity, too. What's that about?
That one shows how the owner's stake has changed over time. It's tied to the balance sheet and shows how profits, losses, and the owner's contributions impact their overall equity.
So it's like a dynamic record of the owner's investment in the business.
Gotcha. Now, this is all good stuff, but what can I actually do with this knowledge? I mean, the book, thankfully, goes beyond just definitions, right?
Oh, yeah. Knowing what the statements are is just the first step. The real power is in knowing how to use them.
So, like, what kind of insights can we get from the balance sheet? I remember the book talked about the debt-to-equity ratio. What's that all about? Well, imagine two companies. Company A has a debt-to-equity ratio of, say, 2. Company B's is 0.5. That tells you Company A relies a lot more on borrowed money compared to the owner's investment.
Ah, so a lower debt-to-equity ratio generally means a company is more financially stable.
Generally, yes, though the ideal ratio can vary by industry.
Okay, that makes sense. What about working capital? That was another term I remember the book highlighting, but what is it and why should I care?
Think of working capital like the cushion a business has to cover its daily operations. You calculate it by taking current assets and subtracting current liabilities.
Okay, and if it's consistently low, that's a problem.
It could be a sign they're struggling to pay bills on time, which, well, can make it hard to keep the business running smoothly.
Makes sense. It doesn't matter how profitable a company looks if they can't even cover their basic expenses.
Exactly.
This is great. I'm starting to see how this knowledge can help me make better decisions, whether in my own business or if I'm thinking about investing.
And that's just the start. There's a lot more we can unpack about using these statements.
Okay, I'm definitely hooked. Let's dive deeper into the income statement and the cash flow statement next.
Okay, let's dive into the income statement now. It seems like this one gets a lot of attention, probably because it shows the bottom line profit or loss, but I'm guessing there's more to it than that, right?
Oh, yeah, for sure. The income statement can tell you a lot about a company's efficiency, and trends in their profitability. It's not just about that final profit number.
So it's about understanding how they got there. What are the steps along the way?
Exactly.
One thing the book pointed out was the difference between gross profit and net profit. I'll be honest, I always thought profit was just profit, but apparently there are different types.
Right. So gross profit is what's left after you take the revenue and subtract the direct costs of making that product or delivering that service. Think of it as like the raw profit. You haven't factored in all the other costs of running the business yet. Okay, so it's like the profit from the actual selling, but not including all the other costs, like keeping the lights on and paying rent and stuff.
Yeah, exactly. To get to the net profit, you got to factor in all those other operating expenses. Things like salaries, rent, marketing, utilities, all that.
That makes sense. So a company could have a great gross profit, but then when you take into account all those operating expenses, the net profit could be much smaller.
Right. And that's why it's so important to look at more than just the top and bottom line numbers.
Yeah.
Break it down and see what's actually happening.
See the components, yeah.
Like, imagine a company that's growing revenue, but their net profit margin is shrinking over time.
That doesn't sound good.
Not necessarily.
Anyway.
It could mean that their expenses aren't being managed efficiently.
So it's all about looking for trends, right?
Yeah.
Not just focusing on a single point in time.
Exactly. Now, another thing I found interesting on the income statement was this extraordinary expenses line item.
Oh, yeah. The book mentioned those, but I don't think it went into too much detail.
Yeah, so those are expenses that happen outside of the normal everyday business operations.
Like what?
Like, settling a big lawsuit, or if there's a natural disaster and the company loses a bunch of money, or if they have to restructure the whole organization, stuff like that.
So basically, if we see a big extraordinary expense, we should dig deeper and see what caused it.
Right. Because these things can really impact a company's financials.
Yeah.
Even though they're usually one-off events.
Gotcha. Okay, so now for this statement that I think trips a lot of people up, the cash flow statement.
That's the one, yeah. It causes some head scratching.
I get that it's about tracking the movement of cash, but why is it so important? I mean, we already have the income statement, don't we?
Right, but the income statement is based on something called accrual accounting. That means it records revenue when it's earned and expenses when they happen, even if the cash hasn't actually changed hands yet.
Hold on. So a company could make a sale and record the revenue, even if they haven't actually been paid yet.
Yep, and the other way around, too. They might record an expense even if they haven't paid the bill yet.
Okay, I'm starting to see the difference. So the cash flow statement is more about the actual money coming in and going out.
Exactly. It gives you a more realistic view of the company's liquidity,
Yeah.
Do they actually have the cash to operate?
Right, because a company could look profitable on the income statement, but still be in trouble if they can't manage their cash flow effectively.
Absolutely. That's why the cash flow statement is so critical, especially for short-term survival.
So how do we actually go about analyzing the cash flow statement? What should we be looking for?
It's broken down into 3 sections: operating activities, investing activities, and financing activities.
Okay, so cash from operating activities, that's like the core business stuff.
Exactly, like cash coming in from customers and cash going out to pay suppliers and employees.
Makes sense. So if that part of the statement isn't healthy, that's a big warning sign.
It could be, yeah. It shows whether the company's core operations are actually generating enough cash.
Gotcha. What about the investing activities section?
That shows you how much the company is investing in stuff like property, plant, and equipment, or even investments in other companies.
So that gives us insights into their growth strategy.
Exactly. And then you've got the financing activities section.
That's how they're getting money and paying it back.
Exactly. Things like issuing debt, selling stock, paying dividends, stuff like that.
So that section helps us understand their overall financial structure, how they manage their debt and equity.
Yep. And when you analyze all 3 sections together, you get a really good picture of the company's cash flow situation.
I love this. It really does feel like detective work, using these statements to piece together clues and uncover the real story behind the numbers.
Love that analogy.
So we've gotten pretty good at analyzing individual statements, but the book also emphasizes the importance of looking at them all together, right? Like, how do we connect the dots and see the whole picture?
That's when it gets really interesting. For example, a company might have amazing revenue growth on the income statement.
Sounds great.
But then you look at the cash flow statement, and you see they're having a tough time collecting payments from customers.
So even though their profits are growing, their cash flow is lagging behind.
Right. That's a red flag.
For sure. Or maybe a company has a really healthy profit margin, but then on the balance sheet, you see a super high debt-to-equity ratio.
Meaning they're using a ton of borrowed money to fuel that growth.
This is really starting to feel like solving a puzzle. Each statement is a piece, and you have to put them all together to see the full image.
That's a great way to put it. And that's the power of understanding financials. It lets you see beyond the surface and make better, more informed decisions.
Okay, this is fantastic, but I know there's still more to learn. What else does the book cover?
Well, in the last part of our deep dive, we'll get into some common mistakes people make when they're trying to interpret these statements. And then we'll look at some practical tips for actually using this knowledge.
Awesome. Let's wrap up this part and get to those mistakes and tips.
Okay, we're back and ready for the final part of our financial statement deep dive. I gotta say, I'm feeling a lot more confident about understanding these reports now, but I know there are always, pitfalls, especially when you're learning something new. The book talks about some of those, right?
It does, yeah. And you'd be surprised how many people, even those who work with financials all the time, fall into these traps.
Oh, really? Like what?
Well, one of the biggest ones is getting tunnel vision on just one statement.
Ah, so not looking at the whole picture.
Exactly. You mean all three: the balance sheet, the income statement, and the cash flow statement. It's like trying to listen to a symphony, but you're only listening to, like, one instrument.
Great analogy. What other mistakes do people tend to make?
Ignoring trends. Financial statements tell a story over time, so it's important to look beyond just one point in time.
So we need to analyze how the numbers are changing.
Yeah, like year over year or even quarter over quarter. It's about context. That makes sense. So if a company's profits have been steadily declining for a few years, that's a bigger problem than if it just happened once, right?
Right. It's about patterns. Now, here's one that trips people up a lot. Not considering the industry. A debt-to-equity ratio that might be alarming in one industry could be perfectly normal in another.
So like a tech startup with a ton of debt might not be a big deal, but for a traditional retail company, it would be a red flag.
Exactly. You got to compare apples to apples. And don't forget, financial statements are just one piece of the puzzle. They give you a lot of info, but it's not the whole story.
Right. We also need to consider things like the management team, the competition, the overall economy.
All of that. Financial statements are like a starting point for your research, not the end.
Okay, that's important to remember. Any other advice?
Oh, this is a big one. Don't be afraid to ask questions. If something doesn't make sense, ask for clarification, especially if you're working with a financial advisor or accountant.
Yeah, that's our money, our business. We have a right to understand what's going on.
Absolutely.
So as we wrap up this deep dive, what's the one thing you really want our listeners to take away?
If I had to pick just one, I'd say, remember, these financial statements are powerful tools, but they're only as good as your ability to understand and interpret them.
So invest in your financial literacy.
Exactly. Learn the basics, ask questions, and keep learning. It will pay off big time.
Couldn't agree more. I feel like we've gone from being intimidated by financial statements to being empowered by them.
That's awesome.
It is. To everyone listening, remember, this knowledge is power. Use it to analyze your own business, make smarter investments, really take control of your financial future. Until next time, keep diving deep.
Did you get any of that?